Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
So this morning we've got headline after headline. It's real or not. We've got headline after headline of lots of Doge inefficiencies or fraud, abuse, waste, however, that's coming through the pike here that's supposed to save us trillions in Medicare fraud payments. But we'll see. There's lots of documentation that still needs to be done, lots of decisions that still need to be made. But obviously, Trump and Musk are on a path of removing a lot of government jobs. And through removing government jobs, they're removing government agencies. And removing government agencies, they're going to remove a lot of real estate from the market that they used to pay on government leases. So CRE, commercial real estate, is going to get hit at some point. Unemployment's going to get hit at some point. Right now, it's being received by the market as a positive, less debt, potential, perceived or reality, less debt. Market's kind of waiting. We haven't gotten the unemployment. The jobless claim this morning was in line, so it's not manifesting itself in the data yet. So we don't have unemployment numbers spiking from government jobs and or contractors and all the universe that feeds these contractors from their spending. So that's going to be coming at some point in the near future, but we don't have kind of any modeling on that. Folks aren't really so focused on that. They're still focused on earnings season, which we are still in. So as far as from a macro standpoint, we have, as you remember, the TGA. I wrote about that and even had that captured as a little video slice so you could really just see TGA in the house means that we've got less of a chance of a serious drawdown. Let's put it that way. So when you got liquidity, it creates that trampoline approach so that you basically have the ability to buy the dip, buy the dip, buy the dip. And that's basically what's been going on. And we're also in this slog fest where efficiencies are good, labor shredding is bad, but they're kind of canceling each other out. Gold did recover somewhat. In fact, some folks that really play in the physical closely are saying every dip is getting bought. There's just no lack of appetite for gold and silver. This is continuous contract. We're already almost got to that 3,000 that's been on everyone's mind for probably a year. Once it started breaking out, we're not quite there yet, but getting closer. Anyway, dollar's digesting again. Oil came back down as lots of headlines are also talking to the effect of peace. And yet, I warn that after Ukraine-Russia drama is handled, the new Secretary of Defense was out, obviously, in headline mode yesterday saying, no, Ukraine will not be allowed to join NATO. No, they will not get back their territories. All those men died for nothing. So families, at the whole communities, etc. It was basically a huge waste of time. And we're going to go back to 2014. So a lot of upset Europeans right now, or folks in the world, but my point is Europeans in particular, because they're going to have to bear that brunt of protecting Ukraine because the U.S. will not supply soldiers and will not let them be in the NATO. So we got that quote unquote, and I don't like this, not a political title of my piece, which was peace, the Trump trade peace. It was that he will strong arm a deal for peace between Ukraine and Russia. And so then he can focus on Iran. That's kind of the next phase. So we've got stateside getting the Doge, fraud, abuse, waste, whatever, in large amounts. And it's very interesting to watch. And way too much time I'm spending on Twitter. Wow, way too much time. Anyway. And then, of course, the other geopolitical arena of peace, which helps the war inflation come down and bonds get supported. And then anytime there's any talk of Iran and escalation, what happens? Pushes them back down. So, and commodities get bid back up. So we have a kind of an interesting war is inflationary as a backdrop. And as peace comes in, bonds have been defended. And as war vibes escalate with talk of Hamas, Iran, then they come right back down. So we're a bit of a shake and bake, both for markets as well as oil and rates. So in the meantime, that's a tough little one to trade. So I put some stuff together yesterday and I showed you that even though we had that CPI that was a hot print and we had a strong move higher in my dollar yield ratio, we had a temporary little move higher in this yield curve, which is the 10 and 2 year. You can see how it's softening again on the peace talk and all that jazz. And then we have my rate differential, which is further down here. So you can see bonds getting a little bounce this morning. Not a surprise. So yen and bonds are having a little bit of a bounce. And this is my dollar yield ratio I was just referring to coming back down. So as this goes up, we get hit and then we got supported very strongly. But I think a lot of that's liquidity in the background as well. And then of course, all the peace talk, which brings this down and that helps it go up. The other part of this is we got Cisco reporting, but no big Mag 7 reversal has been in play. We get some softness in Amazon. We have a nice oversold bounce in Tesla. Those are two current chases. And then Apple is doing well with partnership with Baba. So that's coming up after a 5-week retreat. So we still have the market getting stitched together. Long story short, dollar yen also tagged resistance at that 155 area and came back in. And you can see over here as the dollar yen comes back in, gold got supported again. So hopefully it kind of showed you that you can't do it on a big time frame. You just can't. But sometimes it absolutely pays to have that bond, yen, gold trifecta. When they move together, they have a high beta, but it's not all the time. In any case, dollar yen came back in and gold got supported again. Not surprised. And this rate differential, which really has gone nowhere fast. It looked like it was going to be a head and shoulders. So the bias was like, I see a bit of a bull trap this week. That was Monday morning, but we have not triggered, period. We have not triggered. And this has only gone sideways. So I mean, look at this thing. This is the 7th, and this is Monday. We got Tuesday, we got Wednesday, and Thursday. We just have a little bit. So this has not triggered lower. Didn't get it from Powell. We did get shake and bake for sure on CPI yesterday, and then this jobless claims this morning, not much. The weekend, if we don't have the Hamas hostage situation in line, I guess is the way to put it, in line with Trump's demands, then would not be surprised if we get volatility into a Monday morning. But many people will be absolutely punting, or they'll be hedging for that event. And next week we have options expiration. So we're still in the grips of this clench of volatility. Where the heck is my data? This clench, market not moving too high or too low. Basically, we're just in a chop fest. So this is just to remind, this is the election gap. So we have just done this. This is just not very exciting. We filled that gap on the 13th. We had a nice little bounce up, and then we have just gone sideways. So there really isn't much here. In fact, I can get rid of this because there isn't any really reason to have it. We will have a breakout, definitive breakout, once we can get above this level, or once we come back down and break this level. This is my VIX ratio underneath it. So as it is moving higher, it's bullish. As it's moving lower, it's bearish. And I don't have anything. It's neutrally balanced. So that's also why I went through the intermarket and showed you that I got a lot of stuff here that's just neutrally balanced. If we do break 6,000, I would expect 68.38, and it likely would get defended. So we haven't even been able to break that. You can take a look in the intermarket channel that I don't have a lot of move action here, which is neutral on my intermarket with a little bit of a bearish bias, as I've talked about, but we haven't rolled over yet. I definitely don't trust this until we can get back above these key levels, and then I know we'll be in a push higher, 6150, 6200, that kind of thing. But we're just not there yet. And breadth has it's gotten halfway to where it needs to be, and since it's just gone sideways. So we don't even have that continuation of a recovery in breadth. And really, honestly, this is net volume, net selling, however you want to put it. It's just also kind of creating this head and shoulder formation, which could be bearish, but remember, head and shoulders can also be bullish. So the market really does not know what to do with Trump. All I will say is it still has this backdrop of supportive liquidity underneath. And remember, when this is going down, it is supportive to the market. In other words, it adds liquidity. When it's going up, it takes it away. So you think of this kind of as an inverse SPX. But there is still definitely huge money that is still flowing into China. Here's the China wall from when they reopened. And I took that this weekend, obviously, from the 7th, and we're already on the 13th. They are I know I got a thick crayon here, but I want to make it really clear that we got to get back up above this. We are above it, but not by very much. So it's still working. And then this morning we had a big shake and bake with Baba, and that is to be expected because I've had this Baba 120 on my bingo card since recommending this at $68. So 120 is quarterly resistance. It is monthly resistance. It is the 400 week. You know how I feel about that 400 week. So we're just talking like a massive, if I just clean this up and put this on a monthly, you can see that this is obviously the February 2021 fall from grace, SPACs, K-Webs, China is uninvestable, et cetera, et cetera. Big old overshoot. But in fact, it was this year when it reached $68 as, I forget where it was, 68 right here. Here it is, January. I remember this because it was the 2016 IPO low. I also saw that Jack Ma was buying stock along with the CEO, not as much stock as a CEO. And Jack Ma, as you know, has been kicked out, so to speak, had to go in hiding because he got too brazen about his wealth. And the CCP did not like that. Anyway, long story short, this has been the target. So, and it is still bullish. I mean, this thing is still bullish, but it still has to get above this wall. So we talked about that other wall, which is the Shanghai. I'm talking this wall of 120. It really has to get above and stay above 120. And right now it's pretty darn extended. So is it a surprise that it popped above and then came right back down? Look at that. It popped above that 120 and came right back down. And that's normal. So it's going to likely digest. Remember last time it digested here? It was still very bullish. It stayed above the 8-day. Don't be surprised if this comes back down to the 8-day, which is like 107 area. If it gets a little bit more aggressive, it'll come down to 103.5. And then we'll see if it can actually pull back enough to move higher. So long story short, I got to finish that sentence. When it gets above 120, it is if 120, then 240. So I forget what Jeffrey has for his fair value. In other words, he has done his due diligence on a fundamental basis to run this whole thing down as it relates to its value. And that was long before DeepSeek, So just keep that in mind. This thing has been a monster, no question about it, but it still has to get and stay above 200. It is very extended from the mean. The mean right now on a weekly is literally like this $97. 97. It's very extended, which is why I said they're coming in and buying as if earlier they were buying as if there was a parabola about ready to break out. And then I showed you the chart, which is that parabola of Shanghai. And then as soon as we get right up into the key areas, that's a 400 week, boom, look at the pre-market. So this is not a surprise that we're having a shake and bake right at these key levels. Look at that monthly, that's red. And underneath it, I'm showing you it's the 400 week. So the fact that we're getting a shake and bake here is just not a surprise. But what I want to emphasize again is that this has still done a great job. Even if I just put this on a weekly, I'm on a different time frame now, so gotta bear with me. 2-bar reversal, huge shake and bake, got above the trend line, really stayed above that 10 and 21, and then it got into resistance, that 400 week. But in time, this can still, look at this, boom, shakalaka boom, shakalaka boom. Anyway, the point is, this also has 40 as a very strong, extremely strong resistance level that it hasn't even made it to. So anyway, the point is, that's why I suggested some March, but also June. What is the obsession with BABA? It gets more time than anything. It's true, Brett, because it is so undervalued, for example, relative to Amazon. So you can really, oh goodness, there's so much here. They have e-commerce, they have autonomous driving, they have DeepSeek partnership, they have their own DeepSeek equivalent, Qwen, so they have their own model. Apple just partnered with Baba, not with DeepSeek. Anyway, long story short, Jeffrey has been fundamentally exceedingly bullish on this. I could go and show you, point to where it is intensely fundamentally bullish, but it is one of those deals where a lot of folks didn't want to get involved. China tech plays because we had our own Mag 7 rally. We didn't need to. Plus the uninvestable theme that's been on China for quite a while, the distrust, plus Trump coming in, pushing heavy tariffs on China, potentially up to 60%. So there have been a lot of reasons why folks did not want to get involved in China. The other thing is economically, there's a lot of media that says China is not doing well. Jeffrey would say that's not true. So he has really focused his whole portfolio on China for the most part, and he's up 59% just this year. And it's mostly because of these China plays. So he's very adamant because he's very focused on the value. He's a value trader, arbitrage when things are way too oversold. The US stock market is way too overbought. The China stock market is way too oversold. That was 2006 to 7 before the great financial crisis. This was 2015, 15, which was the yuan devaluation, which surprised and created a huge volatility surge in the US equities market. And that's always been a risk. I have it sorted by RRP, reserve ratio, the rate for China when they've been cutting instead of doing forced deval. This was actually a forced deval, but when you lower your currency, what happens to your assets, this kind of fake inflation, and it always reverses later. But anyway, that's another reason why you've got a potential for a move above this monthly trend line, whether it's a slow move higher or it's a parabola, the potential is there. So there are lots of reasons. And BABA is the reason that most people are excited about China, is because it has done this.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.